and welcome along to the Property Academy podcast. I'm your host, Ed McKnight.
I'm Andrew Nicole.
And today on the show, we're talking about managing your top up on your investment property. What are some strategies that you can use in order to manage that? So right now, when we're looking at forecasting the cash flow of an investment property, a lot of properties are looking negatively geared. What I mean by that is they're going to require a contribution or a top up from you, the investor, to keep that property floating in terms of the bank account. And the reason is that we're forecasting relatively high interest rates, 5.25%, and that's the maths of it.
Yeah, and that's probably particularly true if you're borrowing 100%. So if you're putting nothing into your investment at the start, so no cash in, you're using your equity, which is most investors that we would work with, then you do have to put something in over time. And I think anyone that bought an investment property while the rates were low probably still factored in some sort of contribution at some stage. You don't get a return on nothing, right?
So the question then becomes, well, what are some strategies you could use as interest rates spike to help manage that? That could be because you're purchasing a new investment property now, or you purchased when interest rates were really low and now they're starting to rise. But just before we get into those strategies, Andrew, walk us through what a standard cash flow on an investment property, new build investment property, might be today.
Okay, so I chose this one because I have spoken about this on the show, and I'm just working with a couple of investors that have got this at the moment, and we've been having these conversations around how do we manage this higher top up. So it's right at the top of my mind. So Jabuka, Auckland townhouses, 2-bedroom townhouses, 779,000, 3K worth of setup costs, so borrowing 100%. And then I've worked on an interest-only loan of 4.25% for the first year, and then increasing interest rates after that. But I'll let you talk about that in a minute. Rent of $5.90 a week, 2 weeks vacancy, and then all your normal costs. So rates, insurance, residence association, property management, vacancy accounting, and working on a chattel value of 50K. Now, anyone that's watching this on YouTube will be able to see this. Now, we've adjusted our assumptions. Now, Ed, do you want to take us through the interest rates and why we're using these?
So at the moment, we're predicting whatever today's 1 year rate is. At the moment, we're using 4.25. We're projecting that that's going to go up to 5% by the time we hit 2023, i.e. next year, going up to 5.25% once we hit 2024, and then coming back to 4.5%. Now, these are based off independent economist and friend of the show, Tony Alexander's forecast. The only change that I've made is I've made the long-term forecast after we see those spikes a bit more conservative. So rather than coming back to 4%, we're factoring in 4.5% here.
Cool. So we think these are pretty comfortable rates to be using if you are looking at long term. And look, I actually had the question off an investor just before, hey, what if we do get a higher rate sooner, even higher than what we're budgeting on here? Look, if you are getting a higher rate, chances are rent is going to be going up as well, because of course that's the normal flow on effect.
A rent increase isn't going to make up for an extra 0.5% interest rate increase. Okay. I think what you've got to remember at that stage is that, hey, look, you're likely to make a significant amount of money off property, held over the long term, but you accept some amount of risk for that.
And you've got to be able to hold it for the long term. So now let's look at the cash flow. So the return on investment, as you can probably see on your screen, or if you're listening to this, the average top up a week is $140. So I know a lot of investors say, yeah, look, we're completely fine with chopping up $150 to own that rental property. Here's the problem. Year one, your contribution's less than $5,000. Now, why is it so low, Ed?
Because the property's currently under construction.
Just on the deposit, just the interest on the deposit. Year two, when interest rates get up to 5%, now all of a sudden you're talking about $17,000 a year. And it's kind of roughly around that $17,000 a year for the next 2 years, so year two and year three. Then you'll see it drops off to kind of around that $10,000 a year and then drops down after that. So you've kind of got a few years where you're going to be paying more than that $150 a week average. So there's a period of time where you're going to make more contributions or higher contributions than what the average is. How do we manage that? And that's what the show today is about.
So let's go through some of those strategies to manage that. The first one is to use a revolving credit. So what I mean by that is, let's say you're looking to purchase this property. One option is to set up, say, a $20,000 revolving credit or a line of credit where you are able to then finance the extra top top-ups you'd need to make. So what I mean by that is using debt in order to finance the top-ups. Let me show you what that looks like. So here I'm factoring in.
So this is the new addition to the return on investment calculator. Under the actual property projection, you can put in the amount that you can afford. So let's say these people can afford $175 a week. So they start doing that from day one, and then that builds up a bit of a buffer for that first year. What does the revolving credit look like?
So in this case, they'll need a revolving credit of about maybe $18,000. I'm reading it off the graph, so it's a bit inspecific, but somewhere between 15 and 20 grand is what you need at a revolving credit. Now, of course, a lot of people listening to the show are going to be saying, well, I don't want to necessarily get myself into more debt. But what you've got to remember is you're going to pay this off using future rental cash flow once that property becomes positively geared. So initially, we've got money building up in that account. When the cash flow is particularly negative, that starts to draw down that revolving credit. But by year 10, that's all paid off. And so you're financing through those tougher times. What's strategy number 2, Andrew?
Strategy number 2 is to reduce your own personal mortgage payments. Now, again, you might be thinking, but I'm trying to get rid of my personal mortgage. You tell me to get rid of my personal mortgage, which is true. We're just talking about for the short term. So while you're needing to top up your rental property more than what might be normal based on the long term, can you reduce your personal mortgage? So exactly this again, I was talking to some investors where they were paying $1,500 a fortnight off their personal mortgage. It was way more than what they needed. There were two suggestions that I had. Well, maybe you could just reduce that kind of to, I don't know, $1,300 a fortnight and then direct that extra $200 into their rental property account so that they build up even more of a buffer there. That was scenario 1. Or scenario 2 was continue to pay the $1,500 but split that off a little bit so you've got a revolving credit that you can dip back into to manage those top-ups later on. And we know, based on one of the Westpac surveys, that people tend to pay more than they need to on their mortgage if they've had it for a period of time, because again, when you take out your mortgage at the start, you're paying kind of a loan over 30 years, but as time goes on, people tend to increase it in line with their pay, so that gives them a bit of flexibility. So if you've been living in your house for a while now, 7 years, and you've diligently paid it down, maybe just think about, can I slow that down, even if it's just for the next couple of years while rates are a bit higher, and then look to increase that later on.
And it's really interesting. 68% of borrowers, according to that Westpac number crunching, have paid off more than the minimum amounts required on their investments. That was at the end of 2021. So on average, the median borrower who has paid off more than they needed to is about 11 grand ahead of what they would have to be if they just paid the minimums. So a lot of people out there will have that buffer. Now, look, if you are comfortable with financing that contribution, paying it yourself throughout, interest rates rise, that's cool as well. Just keep your repayments as they are. But if you're looking for ways to make it easier, that's when you might use a strategy like that. Now, let's come across to number 3 as well. Number 3 is start saving earlier. So what I mean by that is, let's say I'm out looking for an investment property and I'm just starting to think about it. And I think, I think I can afford $150 a week to put into this investment property. Well, one option is, before you even start looking, do it today. Start putting that money aside so that as interest rates rise, you're going to have some money in there to help buffer that out. Now, if it takes you 6 months to find that investment property or 3 months to find that investment property, hey, at least you've got a couple of K in there that's going to help finance that through.
The next strategy, which is strategy number 4, is to reduce your Kiwisaver contributions. Now, again, we're not telling you to necessarily do this long term, but maybe it's a good solution in the short term. Now, let's say, for example, you're paying more than you need to on your Kiwisaver. So let's say you're paying 8%, but your employer is putting in the 3%. Well, you're putting 5% extra of your salary aside in a fund that you can't access. So maybe what you should do is look at reducing that amount to the amount that you just get the employer contribution for, because you still want to get that. So let's say you can reduce your Kiwisaver 5%, and if you're on $100,000, that's $100 a week extra that you can put towards the investment, again, for the short term, while you need to top that that up a little bit higher while interest rates are high. And you can always increase it again later on down the track. Or if you realize, hey, actually, this is affordable, we can actually manage it. Similarly, if you do want to put your contributions on pause, again, you need to get financial advice around this. That could be a consideration for you as well. If you say, hey, look, I can't afford to contribute to Kiwisaver and an investment property, well, maybe you can pause it for a couple of years and then direct that money into your investment property. Again, this show is not about giving financial advice, so you do need to get your own personalized financial advice. This is spitballing ideas of ways to improve your cash flow in the short term.
Number 5, one of my personal favourites, and I don't have the sound effect, unfortunately. It's the earn, baby, earn. And this is where you find ways to increase your income. Now, you will have already heard some of the things I'm about to tell you, but I'm just going to keep repeating them until you all actually go out and do it. So the first thing is to increase your rents to the market level. If you still haven't increased those rents and you've got the ability to, and you're currently undercharging compared to the market level, now is a great time to look at that, reassess it, bring it up to that market level. And I'm just going to keep saying it until you do it. The other one, of course, is negotiate a pay rise. I keep saying it because it works, and we just had another pair of investors who, after talking to a mortgage advisor, went out and talked to their employers. They got an extra 20K. And that is going to mean significant amounts of money coming in that they're going to be able to use to pay for things like their top-ups. Let me give you an example. If you currently earn 100K and you negotiate a 10K pay rise, that's going to mean an extra $120 coming into your bank account per week after paying your tax, after paying your Kiwisaver, after paying your ACC levies and all of those things. So going out in a time where the labour market's pretty tight, in a time when, well, don't we know it, it's quite hard to find good staff. If you are genuinely being paid less than the market level at the moment, now is a great time to have that conversation. What's strategy number 6?
Strategy number 6 is one of my favourites. Now, if you're those generous parents that have got bludgeon kids still living at home free of charge, it's time to start charging board. And I like this because this has worked exactly as I'm telling you for some of the investors that I work with. So I work with a couple who have got some kids who are, I think, like in their mid-20s, maybe even later than that.
Oh, bludgers.
And they've provided such a good family home that they don't want to leave. And so I said to them when they came in the other day and we were working through their numbers and said, hey, look, contributions are going to get a little bit higher. Your contribution is going to be roughly $200 a week. They went, oh, is it? Okay. So I said, you need to go home tonight and tell each of your girls they're paying $100 a week. So your $200.
How old are they?
Like mid-20s.
Oh, $100 a week, too cheap.
That's what I said. Well, anyway.
$200 a week.
I told them, go home and charge your girls exactly what you need to make the contributions. And that's what they've done. The kids are now paying the contributions for these 2 rental properties. I said to them, because I guarantee you, when it comes time for retirement, they're just going to put you in a home anyway. So you might as well get your money now.
It's so good. Strategy number 7. I can't believe they weren't charging board already.
Oh, they're such nice people. But so nice
don't be nice.
Yeah, I know.
Charge them. Honestly, you put them through school. You paid for everything. It's time for them to give something back to you. Strategy number 7, parenting advice with Ed McKnight. Strategy number 7 is if you can't afford a growth property, then go for yield. So, for instance, the numbers that we showed just there where it goes up to, say, $300 a week in contributions, which might be a bit high, well, you might be able to go for a yield property if you're unable to afford that growth. So a kind of high yielding property, which we'd typically look at on the show, might in the short term for the first 3 years might be negative $50 a week. Well, that still might be affordable for you, and so you might be able to go for that. So if the top up is a bit high on a growth property, that's where you might start to look for yield.
And the final thing that I want to point out is you need to think about what the long term looks like here. Yes, you are going to be making a contribution. Yes, you are going to have to put maybe more aside in the starting stages than you will later on, but it's probably still worth it for you. Again, the investors that I was working with just this afternoon when I was looking at their numbers, yes, it was going to be a bit of a contribution. They're going to have to make some sacrifices in the short term. But we were talking about $1 million worth of inflation-adjusted capital growth over the next 15 years. Now, there's not many investments that you can get that kind of return with the amount of money that we're talking about contributing over the 15-year period. And if you can actually buy something at a good price today and gain some instant equity, then that makes it worthwhile as well. So, for example, previously we were working on a 4% interest rate going up to 5% in 3 years' time. Under the new modelling that we're doing, we're working on a higher interest rate, which over the next 3 years is an extra 1.25% of interest rate. So if you're buying a $650,000 property and getting a $650,000 mortgage, that's an extra $16,000 roughly of interest that you're going to pay. But if you can buy a property and get it for $635 or give or take, then you've actually already made up that difference. So you're able to kind of be ahead before you get started.
I think it's definitely, we talk a lot about it on the show, and we might have already talked about it in a previous episode.
Bound to.
Usually in the market, something's working for you, something's working against you. That's my favourite saying that I came up with.
Oh, I know you're doing that, debate me.
Andrew came up with it, he says. I'm not sure. We're going to have to ask the listeners who have been listening since episode 2. And in today's market, what's working against you? Higher interest rates and the cash flow. What's working for you, though, is because we're in the market where you're able to find a deal, if you're able to negotiate, get some instant equity, negotiate that better price, then, hey, that amount of instant equity where you buy a property for less than what it's worth, that can make up for that cash flow shortfall. So you can end up ahead. Now, here's the thing. By the time we see interest rates start to come down, and in our projections, we're looking at 2025 that we're expecting that to happen. So that's also where we expect to see the property market start to take a turn. In fact, we'll already be on the increase based on some of the projections I've seen. By the time that comes around, there ain't going to be opportunities for deals.
Absolutely.
That's the thing, because everybody's going, oh, well, interest rates, they're starting to come down. Property prices starting to recover. So while it can be really scary to go ahead and put a property under contract today, by the time it starts to look less scary, there's going to be more demand, less opportunity to create that deal.
Yeah, and if you haven't already, download the return on investment calculator, because this latest version using this revolving credit, which has been a trick of mine for years, is a great way of doing that.
So what I'll do as well is I'll just need to update that link. So producer David will just remind me, and we'll get that either down in the description if you're watching this on YouTube, or you'll be able to find it down in the show notes for this episode. Tap or swipe over the cover art. It's right in there. And of course, don't forget to rate, review, and subscribe to the Property Academy podcast. Really does help us get the message out to more people. Thanks for listening to the Property Academy podcast. I'm your host, Steve McKnight.
I'm Andrew Nicol.
And we're going to be back again tomorrow with even more daily strategies, tactics, and insights to help you get the most of the New Zealand property market. Until next time.